I think I have shared the link meant for me with some friends of mine. So everybody's name appears as Anantha Nageshwaran now.
You can go ahead, sir.
So I think we'll just wait for one more minute, maybe, just for people to, yeah. I think what I have done is I had shared a link sent to me as a panelist to my friends, and therefore it's amusing to find everybody's name appearing as Anantha Nageshwaran.
Yeah, but they can change it. They can rename it.
Oh, they can change it. Okay, I
Yes,
think
yes.
so. It will be a bit confusing. So you can change your name to. You can change the name. Those of you whose name appears as Anantha Nageshwaran, you can change it. Okay. Good evening, everyone. So I think Shankar from Dubai and others can change their name if they want to make sure that their name is correctly represented. I had sent my unique link with to all of you. Good evening, good afternoon, good morning, depending on where you are. I am Anantha Nageshwaran. I'm talking to you from Singapore here. I'm speaking to you in my personal capacity. What started out as an exercise where I wanted to, kind of shoot the breeze with friends on what I see as the outlook for 2022 has ended up being a fairly larger idea thanks to my friend Mr. Harikiran Vadlamani, who wanted to invite others also to listen in. So what follows is just a sketch or a rough idea of my thoughts for 2022 and beyond. After all, we are in the beginning of this decade, and a lot is likely to happen. And this could be a decade wherein politics, geopolitics will dominate geoeconomics and even financial markets. It may not appear to be the case right now. Financial markets seem to be impervious and immune to whatever is going on elsewhere. But I don't think this would last long. So without further ado, I'll be start sharing my screen with you. So expect the unexpected. Maybe it is not that unexpected for many people. So some of you who follow the markets on a regular basis might find this a bit underwhelming. And somebody else who is not very much keeping in touch with the financial markets may find this a little bit disconnected from them. So please bear with me. First things, central banks, especially the US and the Europe, continue to expand their balance sheets. So the growth rate, the second derivative might have come down, but the first might have turned negative, but the first derivative is still positive. Two central banks at the moment have somewhat become quieter, Japan and China. However, I would say that China, there are some stray straws in the wind, if I may say so, in the last week or so. Despite many people saying that the government is committed to carrying through its painful structural reforms, I do see some stirrings of going back to an accommodative stance, both with respect to government bailout ideas and with respect to central bank. I think we need to watch out. These interbank bond markets and allowing parts of Evergrande to be acquired by different state enterprises or local governments or state-owned banks, etc., are initial signs of government somehow stepping in because they are afraid of the consequences. So I wouldn't say that China is indeed walking the talk on reform process. They may eventually cave in. And I will cover China separately. But the important thing right now is the ECB and the Fed are still going strong with respect to monetary expansion. And that is one of the strong reasons underpinning stock markets around the world. Now, in fact, very quickly, this chart has become outdated because this chart shows you the inflation rates in the US, UK, and in the Eurozone. Many of you know the US consumer price annual rate is 6.2% inflation rate. In the UK, it has crossed 4%. And even in the Eurozone, it might be at 4%. So earlier in the new millennium, or especially post 2008 crisis, there was a lot of clamor for high inflation, around 2 to 3%, but they didn't get it. But the central banks have now got what they wanted, and they are now wondering whether did they ask for too much. We will see whether they really wanted this or whether they were only wishing for a 2 to 3% inflation. My thesis is going to be that central banks actually want this inflation. So much of what you hear hand-wringing about the inflation rate, in my opinion, is optics. That's my personal view. So there'll be this kind of a good cop, bad cop routine with respect to inflation in the developed world, because the situation now is far worse than what it was at the end of World War II, when the debt burdens had to be brought down, the debt mountains had to be dissolved through inflation. That is the scenario that we face, except that the debt ratios are even far worse right now. So one of the theses that I always maintain is that while inflation is a very poorly understood phenomena, the real driver, as opposed to what Milton Friedman said, isn't so much a monetary phenomena, but in the developed world in particular, I called it basically a labor market phenomena. Labor bargaining power declined from 1980s. Globalization was the principal reason that diluted the Western labor bargaining power. Technology, globalization, outsourcing, offshoring, and of course, ancillary factors such as falling commodity prices, especially crude oil, food, etc., contributed, no doubt. But the primary driver was technological advancements and globalization, both of which combined to restrain labor bargaining power and wages in the developed world. But now the pandemic, due to some unintended consequences, such as the government's bailout checks, payroll protection, as well as the opportunity to make some faster returns in the stock markets, and due to the stress levels, etc., there is a certain, and the vaccine mandate now in the public sector is clearly heading towards a situation where we might be reigniting the labor bargaining power in the developed world. If you look at the next slide, I'll just move on. You can see here, for example, the unfilled vacancies, even though many people claim that the so-called great resignation isn't really a resignation, that people are still moving from low-wage jobs to higher-wage jobs, which is possible, but still, in terms of data, the unfilled vacancies are at about 10 million in the United States, the highest in 20 years. So naturally, many companies are offering record sign-up bonuses, etc. And that is why even small business owners, nearly half of them said that they raised worker compensation in the last 3 months. So, and you are also seeing anecdotal evidence of generous sign-up bonuses and other benefits, etc., being offered. And this is some sort of a, you may call it a leading indicator or a symbolic warning of what is going on. Historically, if you notice that the price sub-index for the healthcare sector quite closely follows trends in the wages. So hospital wages, which are in this chart, advanced by about 24 months, clearly seems to correlate very well, i.e. there is a 2-year lag after which the overall healthcare price index follows. So now that the inflation rate in the wages of the healthcare workers is rising above 7% towards 8%, it is quite possible that the PCE sub-index component for healthcare will follow, and this could be the precursor to what happens in every other sector. And this indirectly confirms my hypothesis that labor bargaining power, if it persists, and I believe it would, partly because of political reasons and partly because of accidental factors like the pandemic and the policy decisions taken in its wake, the labor bargaining power will pick up inadvertently, and that would in turn therefore entrench inflation. And that's one of the reasons why I don't see it as transient, although the transient rhetoric and narrative will have to be maintained, because much of the advantages of inflation will come only if it is unanticipated. If it becomes too entrenched into wages and too entrenched into interest rate or bond market contracts, then the advantages of the high inflation will be diluted. So effectively, the purpose will be to keep real interest rates as low as possible, possibly negative, and therefore the rhetoric will be in terms of controlling it, will be calling it temporary, but we have to watch for the actual inflation outcomes. And yes, this chart shows us that the wage growth is indeed picking up. Employers are rising wages, and we are at a level going all the way back to almost 4 decades. It's a good thing up to a point because it will create the very inflation that advanced country governments do need. The next slide. However, what we need to watch out for is whether the capitalist or the corporate sector would actually end up resisting this. After all, 1980s, with the advent of Ronald Reagan in the US and Thatcher in the UK, it was a side of a capitalist revolution, so to speak, which tilted the balance of power towards capital. And that is what led to a secular decline in inflation and interest rates. Now, with workers gaining some kind of bargaining power, inadvertently maybe, the question is whether capitalists will be able to sort of close ranks and eventually persuade the central bank to restrain wages. While the reappointment of Powell is due anytime after Thanksgiving, or for that matter, or his replacement. I'm sorry, not reappointment, an appointment of the Federal Reserve chairperson. Even though in practice, there may be very little difference between Powell and Ms. Lael Brainard, who is his contender, the appointment of Lael Brainard would indeed mark a very decisive shift in the optics. And that would mean that the process of wages generating inflation will continue relatively unhindered, whereas at least Powell will have to be little more circumspect, although as I mentioned in practice, there'll be very little difference. So we have to indeed watch out for the appointments. I don't know how close the call is, but if it is Ms. Brainard, it is an important optic shift in the US in favor of higher wages, in favor of more accommodative policies, in favor of relatively more negative real rates, and therefore inflation accommodation. As I mentioned, it is always the case that while there are leading factors like labor cost, ancillary factors do play a role. We might have had a 6% drop in crude oil prices this week, but overall industrial metals, food, and energy prices will remain elevated, partly due to the green agenda as well. And this is where I'm coming to. In fact, this table taken from a textbook I'm using for the course I'm teaching in Mumbai online. Olivier Blanchard's textbook has this very interesting table of what kind of real interest rates prevailed between 1945 and 1970. In general, on average, it was negative in all these 4 countries. Now, I don't have the number for the US right here. I should have probably added because this is his table and not mine. In the US too, the debt to GDP ratio came down from 110 or 120% of GDP at the end of 1945 after the war, all the way down to 30% of GDP by 1970. Especially after the inflationary era started in the mid-60s all the way up to late 70s. The debt to GDP ratio of government debt came down from 55% down to 30%. And in the UK, the decline was even more dramatic during the inflationary years of the 1960s and 70s, when it peaked almost at 24%, the inflation rate. So you can imagine, although the growth rates were good, the real interest rate was so negative, inflation rate was around 4 to 6%. And that is the kind of outcome that I think will be required, notwithstanding the short-term noise, whether inflation is going to be controlled or not, etc. In general, as I look out towards the decade, I do believe that there will be a mini or a maxi rerun of the 1970s with respect to inflation. So that is where we are as far as the US and the UK is concerned. My personal view remains that inflation is a preferred or a sought after outcome rather than something that has happened accidentally. Basically, the principal reason being technical default of the debt burden and the need to bring it down. The only risk for the United States, which we will deal with later, is, of course, what happens to the US dollar if this continues. And with the advent of the cryptos, I mean, right now I read recently that the overall market cap of all cryptos put together is close to $3 trillion. And that is indeed a challenge to the monetary authorities in the world. So given that development, and given the overall geopolitical developments, is there a threat to the dollar? Not now, as we approach the end of the decade, because right now, Eurozone and China are not in particularly great shape to challenge the US dollar's hegemony. But that is something we will come towards the end of the presentation as well. Moving on to China, I think there is a feeling that China is having a lot of control over the situation, which I not quite agree with. They have put too many balls in play, and it is very difficult to make sure that they will be catching all of them as they come down. The first thing is that we know that for the last 4 months consecutively, land sales by local governments have declined. And the manner in which Evergrande has been somehow avoiding technical default has not been very reassuring. Although, as I mentioned earlier, nascent signs of the government orchestrating a bailout is emerging, because China doesn't want to give the appearance to the outside world or to its own citizens that a bailout is indeed being launched, as it was after 2008 crisis. This is being done in stealth. So the feeling that China is biting the bullet on really reorienting the economies, unlike the Western countries, in my opinion, passes very little muster as far as I'm concerned. So local government revenues will be indeed affected. As some of you might know, in its Article 4 assessment report of the Chinese economy, the International Monetary Fund always presents its own estimate of Chinese government debt and deficit, which turns out to be much higher than the official Chinese government estimates. So in that sense, I think the continued stress in the property sector will have a knock-on effect on local government revenues, given its share is very high. And secondly, in the corporate sector, high-yield borrowers are going to find it difficult to sustain their borrowing program. So recently, the cost was seen at 25% for high-yield dollar issuers from China. This will also have a knock-on effect on capital formation, whatever little was left of it in the private sector, non-real estate. And that will be also another drag on growth. So there is a drag on fiscal, there is a drag on growth as well. Talking of technology leadership and China's decoupling, frankly speaking, based on research by Fathom Consulting, it's not my research, they basically say that China's advantage, revealed comparative advantage, is more than one, only in relatively lighter technology, lightweight sectors. In the so-called sophisticated sectors, China's RCA is below 1, which means its specialization relative to the world is actually low rather than high. So among the sectors which have an RCA greater than 1 for China, the only thing that you can think of is maybe something called omnibus, called machinery and other manufacturing. Other than that, it is clothing and accessories, building materials, rubber, etc. So clearly, China hasn't stolen a march over the West when it comes to sophisticated manufacturing and technology. And what is the progress within China itself, if not you compare across time? Yes, definitely, if you look at where it was in 2005 and where it is now in 2020, in advanced railways, the lead China enjoyed has actually come down. So is the case with respect to maritime engineering compared to 2010. Maybe with respect to information technology, it has maintained where it was in 2010. But only in new energy, which is sort of renewable energy in other areas, China is probably doing a bit better than what it did about 10 years ago. But in other sectors, really the progress has been either slow or stagnant. So by and large, excepting in new energy, one would say that it doesn't really sort of create a major gap between itself and the rest of the developed world. That's not the case. What about the rest of Asia? are they going to suffer if China indeed slows down? The answer is particularly not the case, because if you look at the highest exports from the rest of Asia to China, it's Vietnam, whose export to China as a percentage of GDP is somewhere around 16 to 17%, followed by Taiwan, somewhat unsurprisingly, since many Chinese companies did indeed locate there and then ship it back to China for final finishing before being re-exported. So in fact, the argument is that many of what is coming from China aren't still really Chinese made, but China finished. And that is what is you see with respect to the export share of Taiwan and Vietnam, which are really the intermediate processes before China completes it. That kind of confirms what you saw in the earlier two slides, where China's revealed comparative advantage was relatively on the lower side. Capital economics made this very interesting projection, and this has got a geopolitical implication. If you look at the US-China GDP, China is supposed to close the gap from 71% at the end of 2020. It will probably come very close to 87% of US GDP, pretty close. However, by the end of the decade, they project that China would actually be at 81%, which is a little bit of a regression from what it would be in 2030 towards 2050. So some kind of convergence is expected to happen this decade, but this was well before Evergrande and China government's regulatory interventions in the tech sector happened, by the way. February 2021 estimates. By 2050, China would actually be having a larger gap with respect to the US GDP. Therefore, it could very well be the case that China is an economy and a country in a hurry, given declining demographics, given the ongoing stress in one of the most important sectors in the economy, real estate, and the capricious regulatory interventions in the tech sector, with implications from all of this for potential GDP growth and for Chinese government finances. Leyland Miller, who heads the China Beige Book, recently said, China's growth rate is going to be slowing down appreciably, but he added a but the Chinese government is very Communist Party, is very comfortable with that. I'm not so sure, because I do believe that the legitimacy of the regime is indeed still bound up with economic growth and prosperity. So I am a bit skeptical that China is indeed willing to accept a lower growth rate. The proof of the pudding will be in the eating. We will see what happens. That's why I'm saying that there is stealth stimulus already underway in China. This is continuing from where we were in the earlier slides. This is actually on par with the question marks that are being raised about China's GDP statistics. So, for example, the World Bank and the Chinese National Bureau of Statistics put the share of high-tech exports in the overall goods exports at 30%. But Fathom Consulting, with his own estimates, and you can see the link that I've given you there to get some idea of what this is, how they compute it. They showed the export share of GDP of China at roughly half of what the official data and the World Bank data show. So where all this is going to lead to is going to be a huge tug of war between businesses and geopolitical strategy. We all know that the reason why globalization partly advanced was also because of the collapse of the Soviet Union, and the United States therefore dedicated its attention to helping the rise of China. And it's also possible that US businesses were seeing a big opportunity there. And it took 2 decades after the Nixon visit for it to start fructifying slowly in the 1990s, which of course gathered a lot of momentum after China entered WTO in 2001. So globalization gathered momentum because the US thought that the two worlds, the communist and the capitalist world, that kind of ended. So they could now use the entire world as a global manufacturing space, and your entire pool of labor actually is no longer domestic labor, but the global labor force. So the decade of the 80s laid the policy foundation in terms of laissez-faire, inflation targeting, etc. And then the next step is China's admission into WTO, following 2 decades of impressive demonstration of market socialism, as they called it, freedom to farmers, town and village enterprises being allowed to flourish, restructuring of state-owned enterprises in the 1990s, and then eventually in the new millennium entry into WTO. Because US had indeed helped the rise of Japan and Germany post World War II, and ASEAN was always in the radar because of the anxieties over spread of communism from Soviet Union to Vietnam and then over to the rest of ASEAN. But when Soviet Union collapsed, all these priorities had to be shifted. And Japan, once it emerged as a threat in the eyes of the US, then Japan basically had to be tamed, which is what happened with the strengthening of the yen and the collapse of the real estate bubble. But China, US thought that it could repeat the act with respect to China, but given China's civilizational angst and hurt, that the script hasn't really proceeded the way the US wanted with respect to China. So now the geopolitics and the political compulsions is shifting slowly. But even in the US right now, you have a government that isn't particularly very clear about how it wants to deal with China. Nonetheless, the groundswell of political opinion, if you look at the Congress, if you look at the some of the congressional party members across the aisle on both sides, there is a shift in terms of the political strategy. The question is, businesses which enthusiastically supported or even led politics by integrating with China, are they ready to bite the bullet? The answer is no. And that is going to set up the conflict. What you see here in this slide is a bunch of headlines from different sources, how European and American businesses continue to be very bullish on and continue to stay invested in China. So until now, for all the talk of supply chain relocation hasn't really happened yet. It is still at its nascent stages. You can see Volkswagen, Mercedes-Benz, Goldman Sachs, BlackRock, financial as well as non-financial businesses continue to stay engaged with China. That is why I say that globalization might have ended. It may not be proceeding at the same pace, but I don't think deglobalization has really started. But as the decade advances, I do believe that eventually business will have to follow where political strategy is leading. Deglobalization will begin, and that will also add to the inflationary pressures, because globalization was one of the key factors behind the disinflation of the 80s and 90s and the new millennium. So for the time being, of course, the United States corporate sector is very much in hock to China. And in fact, this story, if you haven't read, US PE and VC companies continue to aid China's bid for chip dominance despite security concerns. And you might have also read the story of a secret port project in the UAE that the US is concerned about. But within the United States, as I mentioned, even though the government per se at the highest level is confused, with respect to foreign policy, it is not a surprise that there are multiple sovereigns within each country. So, for example, Chinese embassy lobbies US businesses to oppose China-related bills in the Congress. That's a story from Reuters. Separately, there's a story that FCC unanimously voted across party lines to halt China telecom operations within the United States. So you have this multiple sovereigns at work within the United States. And my opinion is that by the time the middle of the decade comes around, even after 2022 midterm elections or after the 2024 presidential elections, this will crystallize something more concretely. And as we look ahead, I feel deglobalization will advance much faster in the second half of the decade. So therefore, my view on China is that potential growth will be much lower. The Chinese government will not be able to handle that. They will try and re-stimulate the economy. And that, until recently, has not really led to any material deterioration in their credit ratings and etc. But I do believe that as we go into the second half of this decade or later, China's credit rating will be in jeopardy. And I don't think, therefore, from an economic perspective, China will be able to have a yuan pose any challenge to the United States. So for now, the US is benefiting from the TINA factor, and it may be the case, but it also opens up the risk of China becoming more adventurous geopolitically. So in this regard, I really do endorse the view of Hal Brans and Michael Beckley, two professors who wrote that China is in a hurry in political terms, not because it is a rising power, but because it is a declining economic power. And that, I think, resonates very well with what I'm seeing in the macro data. Now, notwithstanding whatever happened yesterday in the Indian political decision making, the Indian glass is still very much more than half full in my view as we talk about India. So just to go back, many people ask, how is it possible that India would be able to get back to a higher growth path? All I'm trying to point out here in this slide is that even before the pandemic happened, some very specific developments related to monetary policy, related to liquidity policy, and decision-making issues in the Ministry of Finance, thanks to the ill health of the previous finance minister. All those things combine to create the growth stagnation, a policy paralysis, and restrictive monetary policy and inadequate response to the collapse of IL&FS, which came on top of the ongoing banking system stress. So these were one-off or special factors that brought down the growth rates from 6 and 7% down to between 4 and 5% even before the pandemic struck. So the mere dissipation of these one-off factors alone would be adequate to restore growth towards 6.5%. And on top of that, when we have structural reforms, and setbacks are quite common, some of us would remember that in the late 90s, there was a lot of expectation that government of India would allow foreign airlines to pick up stake. And there was an alliance between Tata's and Singapore Airlines supposed to start international carrier. At the last minute, the then Civil Aviation Minister, Ghulam Nabi Azad, announced that it wasn't going to happen. And then we know that Air India privatization has been on the works for a long time. We know about GST and IBC, how long they have been in the making. So the farm sector reforms, which for whatever reason had to be currently repealed, because in any case, many state governments, opposition rule state governments said they won't be implementing it. I don't see it as a permanent or a big long-term setback. It may be it may make its reappearance in a different garb and probably in a much better process as well in the next couple of quarters. So I don't see that as a very enduring setback to the reform process. And even without that, my point here in this slide is that special one-off factors that held back growth in 2018-19 and 2019-20 are already on their way out. In fact, if anything, my concern will be that we don't repeat the mistake of the 2010 to 2013 period, wherein we allowed stimulus to stay on for a much longer period. But that is something which we will see later. One of the reasons why India's growth in the first decade was very strong was in 7 out of 10 years in the first decade, the rupee appreciated against the dollar. In the second decade, the opposite happened. Only 1 out of 10 years, the rupee appreciated in 2018. Imagine in 2018, the US was raising interest rates and the rupee appreciates, which normally shouldn't be happening, because when the US is raising interest rates, everything else being equal, dollar becomes attractive and dollar should strengthen. And emerging market currencies normally feel the heat when the United States is raising interest rates. But in spite of it, in 2018, the Indian rupee appreciated. So you can imagine how restrictive Indian monetary policy setting might have been in 2018. So real rates were quite high. So because RBI continuously overestimated the inflation rate and kept real rates very high. And that is the reason why in 2018, rupee appreciated. The blue bar below zero means USD INR goes down. So the first decade, we had rupee appreciation. Second decade, we had rupee depreciation, and also it compounded with the financial system stress. Therefore, India's dollar GDP in per capita terms grew very, very weakly in the second decade, leading many people to call it, therefore, the last decade for growth. But the bulk of it is mainly due to the fact that the Indian rupee weakened quite a bit between 2011 and 2013. So the net result of it is what we see as the continuous decline in nominal and real GDP, especially in 18-19 and 19-20, and then the pandemic year. But where we are right now is that, sorry about this slide, but full of numbers. This is from the Petroleum Planning and Consulting cell of the Government of India, Ministry of Petroleum. You can download it yourself. What you are trying to say, what I'm trying to show here is on the right-hand side. Focus on the fact that growth in petroleum products consumption is up 11%. Production is also up 11%. And the overall consumption has indeed picked up about compared to the previous year, first 6 months. So if you go back all the way to the left side of the slide, you can see in 2019-20, it was 214 million metric tons. We may end up crossing it if the growth rate continues to remain good in the second half of the financial year as well. We're already 2 months into it. So this is a clear sign that indeed we are getting back to the pre-pandemic growth track. And on top of that, with monetary policy accommodative, with structural reforms having already happened, I do see that on a sustainable basis, we are already on track for 6 to 7%, not just for the next year or the year after. I'm saying in the medium term, we are on a sustainable path of 6 to 7% growth, which is pretty all right, very respectable. However, the question is, are we going to be able to take it beyond 7? And that depends on two things, capital formation and credit growth picking up. I would concede that the signs are still not there yet with respect to the banking sector, credit growth to the corporate sector. You can see that in the 1990s, we had around 25 to 30% of GDP, which was the ratio of the bank credit to non-financial sector. And then it took off in the first decade, going from 30 to 55%, which was a pretty big jump, 25 percentage points in a decade when GDP also was growing at 14% nominal GDP. So you had a situation where credit growth, bank credit growth was running at probably 20, 22% per annum on an average. And that naturally led to indigestion and stress. And that is why the bank credit to GDP ratio stagnated quite a bit throughout the last decade. And that was one of the principal reasons for growth slowing down, not because of, small factors like demonetization or GST introduction or IBC, which were definitely requiring behavioral changes on the part of the industry. But I would consider them as short-term factors. The real big stress factor was the credit indigestion, credit excess of the previous decade that had to be worked its way out of the system. And now that it is behind us, I do feel that the rest of the decade, we should see this growth, this line picking up and heading towards 70% of GDP as the decade progresses. That is my second reason for optimism, that A, we have removed some of the temporary factors that held back growth. 2, credit growth should pick up because the process of indigestion has been sort of ameliorated. And then we have multiple reform packages, even though I might have not included some of the 5 Atmanirbhar packages that came out last year. In fact, I should add here 2 things which might make a difference very substantially, and they may not attract the headlines of newspapers, which is the Gati Shakti, which is the information dashboard of collaboration and coordination between government departments and ministries at the union government level. And the last one announced October 29th in public procurement policies, including a mandatory 75% payment within 10 days of completion of the project by the government. These from the point of view of governance, in my opinion, are quite transformative, and the impact of that would be felt as the years roll by. So I should add those 2 boxes as well, Gati Shakti and public procurement reforms. FDI numbers starting from 2014 crossed $30 billion net FDI. I mean, that is gross FDI into India minus FDI out of India, crossed $30 billion. And in the last financial year, it was heading towards $45 billion. So we will, in my opinion, given whatever is going on in China and given whatever is going on among the other BRICS countries, if you look at even outside of BRICS, Turkey or Russia or Brazil, India, even without doing anything spectacular, should become a natural beneficiary of investors' attention. And in a way, it will be a continuation of the trend that we have witnessed since 2006. This is a chart from T. Ravishankar's speech, a very good speech on capital account convertibility. He showed that India's cumulative FDI inflows far outstrips portfolio flows. That's, I think, a very healthy sign. And in my opinion, this trend will indeed continue. Um, there is a policy and business confidence improvement index of the NCAER, which is quite interesting one, because they measure both business confidence as well as political confidence. They showed that the political confidence index also after the first quarter anxieties created by second wave has picked up indeed quite dramatically. In fact, if anything, if you look at the next slide where they give you the breakdown of the components, excepting with respect to managing inflation and managing unemployment, the confidence level of businesses, because they do send the survey to 500 listed entities, and it's a fairly widespread survey. The confidence level on many other aspects has picked up quite dramatically in the last, compared to the previous quarter, and so on. So now, ultimately, the question that all of us will be having, and I don't have a concrete answer, it is my guess and partly based on historical trends, which is that how much of this, all this will lead to capital formation in the Indian private sector. Now, this chart is not based on any intentions announced by the corporate sector or sell-side reports. It is based on what RBI gives us every year, based on the bottom-up reports filed by businesses with the RBI for fundraising for actual investment. So this is phasing of CapEx projects funded through banks, other financial institutions, IPOs, external commercial borrowings, foreign currency convertible borrowings, rupee denominated bonds, and IPOs once again appearing there. So clearly, this is a much better indication of whether they are putting their money where their mouth is. And as you can see here, clearly due to the balance sheet stress in the corporate sector, the actual phasing of CapEx was indeed coming down throughout the decade. But interestingly, as you see, between 2019-20, it was beginning to recover before COVID struck. What I show on the line, the red line, and the numbers on the top of it is capacity utilization in the manufacturing sector. So capacity utilization rates, even though they remained high, that did not come in the way of the CapEx recovery beginning to appear in 2019, 18, 19, and 19, 20. Okay, so the argument that capex rates are so low right now should preclude capital formation has definitely an element of truth. But if we dig deeper, thanks to CRISIL, you can see here that some of the building blocks of a capex revival are in place already. Free cash flow to capex is the highest in the last decade. Corporate tax rates are the lowest, and bank lending rates are the lowest for listed entities as well. And more importantly, if you break down the capex utilization rates between small firms and large firms, for many large firms in different sectors, steel, cement, pharma, and FMCG, the capex utilization rates, capacity utilization rates are much higher for the large firms, and hopefully they will be able to first lead the investment revival. So as I said, we are talking about 2022 and beyond. So I'm not expecting anything to fall in place, everything to fall in place right away, but we are discussing the trends for the decade. So my expectation is that if these things begin to pick up even more, then heading back towards 7% on a sustainable basis becomes that much more realistic. And with opportunistic breaks coming through other sectors, through foreign direct investment and more structural reforms at the state and the local government level, even crossing the 8% threshold by the middle of the decade after the elections, etc., should definitely be possible. And for the time being, at least, the government is walking the talk. RBI's State of the Economy report published just about a couple of weeks ago. It points out that the capex is up by 38.3% compared to last year, and compared to 2019-20 pre-pandemic, central government capex is up 22.3%, with the defense and roads leading the way. So government capex spending, which has the ability to act as a force multiplier, is doing its job in some sense. What is the risk factors? In a way, the IMF is identifying some risk factors for India, which is inflation, because IMF indeed brought down India's dollar GDP forecast compared to April. The October forecast is down by $140 billion. In other words, our IMF says real GDP will grow slightly lower than nominal GDP, which in other words, effectively saying that inflation will be higher in India. So in the last 6 months, IMF has revised up India's inflation trajectory for the next 5 years. In contrast, it has revised down China's inflation trajectory, so much so, China's dollar GDP is almost $1 trillion higher at the end of 2026. So whereas India's nominal GDP in dollar will be still less than $5 trillion, the fund is projecting China will be close to $25 trillion. Now, we can debate this and discuss this ad infinitum, whether the fund is biased or not. But I would simply argue that a sanguine view on US inflation that the fund is taking, whereas a somewhat pessimistic view on India's inflation, leading to a rupee depreciation against the dollar all the way to 89, which is the implied forecast of the IMF by 26-27, is, in my opinion, rather excessive. And my personal view is that in the light of all that I have said so far about reforms, about FDI flows, about the financial cycle having been completed in a way, I see the repeat of the first decade of the new millennium when the rupee strengthened in 7 out of 10 years rather than depreciating. So it is, if that is the case, if you're able to maintain a real GDP between 4 and 5%, and you have a currency appreciation, you are talking about a dollar GDP growth of somewhere close to about between 12 to 13% rather than 8 to 9%. So that will be a dramatic impact. And the IMF, in fact, hasn't really downgraded China's GDP forecast. It continues to project between 5 and 6% real GDP growth in China. And based on whatever has happened in the real estate sector, etc., and with the China Beige Book saying that growth rate will be materially lower in China, and that the party is comfortable with it, these numbers may turn out to be too optimistic in the case of China and too pessimistic in the case of India. The fund also has done something very strange with respect to India's potential growth rate. Back in 2018, the fund thought that India's potential growth was around 7 to 8%, but now it is in line with the actual GDP growth revision. It has lowered the potential growth going forward to somewhere between 5 and 6%. And what is funny is that even the historical potential growth rate, instead of 7 to 8%, as I showed you in the previous chart, has been brought down to 6.3%, etc. In other words, the potential growth estimate actually sort of belies the definition. It just seems to be some sort of a trend following of the actual growth rates rather than a trend setting growth rate based on a model that takes into consideration potential resources availability and growth rate. So this is a joke. So I think the potential growth rate, notwithstanding the pandemic, is probably somewhere between 6 and 7% in my view. Many of us, of course, are definitely familiar with this chart based on the IMF data. China's GDP, as we saw just now, it may go to 25, but right now it's close to 15 at the end of 2020. And India is a shade under $3 trillion. That's a 5 times gap. However, if you kind of deflate China's and India's GDP with the overall non-financial sector debt, then the Indian orange color line lies above the Chinese blue color line. In other words, until about 2005, India and China's GDP, even in this, you can see here, it wasn't that big. It really, the takeoff point happened in 2005 for China. And that is the time when it started slowly believing that it can decouple from the US. And in 2008, the US crisis gave China a sense of overconfidence, and it thought it could borrow its way out of trouble and nothing would happen to the economy. And moreover, it also panicked. So the Chinese reaction to the US crisis was a bit of a mixed one. There was a sense of euphoria and there was a sense of panic, both combined, and the borrowing exploded and so did the GDP. So in a way, it is like a hedge fund returns. Its leverage juiced up GDP growth post 2005. I am not at all minimizing or trivializing China's stellar growth performance in the first quarter century after reforms. That was a pretty genuine burst of reforms-induced growth rate. But post 2005, 2006, and especially after 2008, growth, in my opinion, has been largely led by a real estate sector growth funded by borrowings. That is why I think India, given its relatively restrained overall borrowing, thanks to the, in a way, the balance sheet repair that was happening throughout the last decade, has a greater potential to use leverage a bit more this decade and bridge that gap. So, so growth rates deflated by debt doesn't look as dire as the previous slide looked. So the risk factors, in my opinion, therefore, is not that Indian growth party will not get going, but that the party may become too rowdy as it did around 2008 and 2010, 11 and 12. So in terms of multiple stimuluses, monetary and fiscal. So if you look at the RBI balance sheet as a percentage of GDP, isn't too small. It is heading towards 30%. Whereas the Fed is heading towards 35, 36, 40%. So it's important that at some point, while the current RBI governor has very deftly managed the past 3 years, the real test will come how far to sort of pull the punch bowl without necessarily affecting the growth rate. And to some extent, if the Indian stock market indeed goes down, it may not be a big unwelcome thing from the policy point of view, at least for the short run. Inflation expectations in India haven't really followed the inflation targeting regime. If you look at it, actual inflation rates experienced in the food market and in the energy markets have driven India's inflation expectation. This is the RBI survey of households. What proportion of the households surveyed, about 5,000 of them in 18 cities every 2 months now, and what proportion expect double-digit inflation? The good news for RBI is that this number used to be 70 and 80% thanks to the double-digit inflation we experienced between 2009 and 2014. But now it's still around 50%. So half the survey participants always expect 10% inflation or more. It's important that this doesn't become too entrenched with the percentage rising towards 70%, etc. And that is why I think to some extent, excess liquidity provision and keeping real rates too negative shouldn't be carried on for too long. So final thoughts as we head towards the last lap. In the United States, notwithstanding all this talk of taper tantrum and monetary policy normalization, let's remember that in 2018, they took the rates all the way to 2.5% before the cookie was about to crumble. And they made a about turn in 2019 and rates began to come down even before the pandemic happened. So I think the United States has no potential to handle even 1% Fed funds rate in nominal terms, forget about 2%. Therefore, I think whatever tightening happens in the US, if it does, will be very transient. It is not inflation that will be transient, but policy normalization will be transient. And you saw that in the US Treasury budget projections for the next 10 years. In July, the new government gave its budget projections, which is a red color bar. Treasury has to give its own forecast of real short-term interest rate, 91-day T-bill real rate. What is interesting is the Treasury has projected a real negative 91-day T-bill rate all the way up to 2030. Never in any of the past budgets, I went back all the way to 2000 budget, never has this kind of a projection been made. This is probably either an anticipation or a wish list or a picture of reality as far as the US is concerned. Given the debt burden it has, it needs real negative rates, and maybe that is what the Treasury has projected. That's a very, very important giveaway in a way. So I wouldn't give too much of importance to these. Talk is cheap. As far as the market is concerned, many of you know this very well. I don't have to belabor this point. Whatever metric you want to assemble, not only metrics, but also the ecosystem and the chatter in the marketplace, given whatever is going on with the entire crypto world valued at $3 trillion. If you ask me, it is every passing day becoming a very important near-term risk for growth in the developed world in 2022. Many people always ask for a trigger, and as Jeremy Grantham says here, you will very seldom identify the trigger, the pin that pops it beforehand, ex ante. Most of it is very clear with the benefit of hindsight. So the truth is, the biggest cage rattler of all is everything else you have been thought about. It is not monetary policy. It is not geopolitics, maybe whatever. Any accident can happen given the excessive speculation and greed and leverage that is currently out there. So it is the biggest risk. But I would tell you, if it does happen, it will actually be a very good thing, what the doctor ordered for India, because it will remove the froth in the Indian market. It will take away the policy dilemmas that RBI is facing. It may bring down energy prices, because in the near term at least, because growth rates in the developed world will definitely slow down. And policy in the developed world will once again be forced to become expansionary after a brief hiatus. And that means the pressure on monetary policy freedom for India will once again open up. So if we have a quarter or two of financial market downturn in the United States, and leading to a correction in the Indian market as well, I would actually consider that as a welcome sign, removing all kinds of policy dilemmas for the Indian central bank and the government. Geopolitics, as I said, is going to dominate. This is a very long slide with a long text. I won't read the whole thing. Basically, this was written well before the elections in the US last year in September. The important point is this decade does indeed promises social conflict and further unrest right up to the presidential elections in 2024 and beyond. And I think the country still remains polarized. You can see the reactions to the acquittal of Kyle Rittenhouse, I forget the name fully. So in other words, the turbulent 20s is still ahead of America, even if the election hurdle is crossed. I wrote this in September 2020. The election hurdle, in whatever manner it was, has been crossed, but the decade will still be a turbulent one for the United States. A month before that article, I tried to take a sort of a peek into how geopolitics might unfold. We have to watch out for the kind of Eurasian landmass alliance that Harold Mackinder wrote about. So we need to look out for what the new German chancellor would do. So we need to watch out for German, Russian, China kind of arrangement or alliance, or formal or informal, coming through. The United States would actually try and appease China, as this government is trying to do. But the US dollar, therefore, even though in the near term, it appears to be that there is no alternative, but it is ultimately global reserve currency status is more a political decision rather than an economic decision alone. But it could be threatened by a coalition of the euro and Chinese yuan. This is sort of blue sky painting idea. So you might at the moment think I'm just sort of talking nonsense here, talking about the alliance of Russia, China, and Germany, etc., and coordinated alliance of Europe and China threatening the US domination. But stranger things have happened. So you need to just keep this in the back of your mind. And it is not something I'm talking about for the next year or the next year or the year after, but we are painting the picture for the entire decade. In fact, I'm saying that things may have to get a lot worse in the United States before its elites, both political and business, come to their senses and the rebuilding of the country begins. So right now, what we are seeing is the unraveling, and it has barely begun in the United States. It is, in fact, the worst thing that happened to the US was the collapse of the Soviet Union, because all said and done, you need competition. Moment the competition wanes, internal contradictions always emerge. Professor Joseph Henrich, I would strongly recommend this book, even though it's a bit laborious reading. Without competition, elites will actually fight among themselves. State level institutions will be torn apart. Cracks, gaps, and loopholes will appear, allowing narrow elite interests to flood in, as lineages, clans, and sometimes entire ethnic communities devise ways to exploit state institutions for their own ends. Complex societies always collapse as the higher level institutions that integrate and unify them eventually deteriorate and crumble. For those of you who are not already familiar, I would also recommend The Fate of Empires by Sir John Glubb, a great speech made in 1977 that kind of foretells or even foreshadows a lot of what is happening in the United States right now. And some of my own writings in the last 1 year in Mint, trying to take a look at how geopolitics would influence geoeconomics in the course of this decade. And the US, like its predecessors, is already into 100 years of its kind of dominance. So maybe its time is up. We don't know. We will see by the end of the decade. It is a very non-trivial probability that the reign of the US dollar as a global reserve currency may come to an end by the end of this decade, unless the US miraculously gets its act together politically and economically well before that. So thank you very much for listening to me patiently. As I said, it's my personal view. Some of you may have found it underwhelming, some of you a bit overwhelming. My apologies. I hope it does help you to form your own thoughts much more clearly, whether you agreed or disagreed with me. Thank you very much. We have some time in case you have questions. I'm happy to take them. Otherwise, yeah. There are a couple of questions here. 2018 dollar inflow into India may have been due to 2019 election funding cycle. Possibly. I didn't talk about dollar inflow. I simply said rupee appreciated. Could be due to monetary policy, could be due to fund inflows. But in the absence of magnitudes, I have no idea. Maybe you are right. I can't speculate here. But the fact, it is true that India's real interest rates were quite restrictive. Kaushik has a question here. Before the third term, there may be a possibility of China invading Taiwan. Yes, but it is possible. I mean, nothing, you can never say no to anything. Will it change the analysis? I mean, well, it will definitely change the analysis, and it will be somewhat facile on my part to say, I have thought through it already. No, I have not. But that said, some initial pointers I can give you. It may probably make the US administration become a little bit more firmer. I mean, after all, if you remember back in the 1930s, a similar situation prevailed with respect to the Allied countries' attitude towards Germany. Elites were very happy to continue to appease Hitler, and the Naval Chamberlain government actually was one of them. But surprisingly, out of the blue, the Chamberlain government gave a security guarantee to Poland, which basically made it into a global conflagration. So like this happening, that UK government's guarantee to Polish security guarantee, if something were to happen with respect to Taiwan, that may actually make the United States finally get hold of itself. And God knows, that may be actually the competition that the US really needs, which it has been missing. So it might actually concentrate minds like nothing else can. So in that sense, it may be actually a good thing. Ruchir actually said it will be close to 5.5%. In fact, he wrote after the 2008 crisis, because he said one of the biggest contributors to the 2003-8 growth episode was the export growth, which added a percentage point or a percentage and a half to overall GDP growth. So he kind of said, if you have deglobalization, etc. But look at what I was saying. In the second decade, India's export growth was pretty bad, almost flat or even mildly negative. Some of the people on this call might even have the statistics in their fingertips. I don't have the numbers. But in spite of that, until the 2018, 19, 19, 20 slowdown happened, we were clocking, towards 7% or even slightly more. So I would think that 5.5 strikes me as a little bit of an over pessimistic estimate, maybe at the lowest end of the possible range. I would still hold my view that the reduction from 6.5 down to 4.5 to 5, or 4 to 5 that happened between 1819 and 1920 was due to one-off factors. So I would still hold the view that getting back to between 6 and 7 is the first intermediate target, and that is doable. Sorry, the climate change slide I missed out. I think it is actually more of a factor for inflation for the time being, because it is going to mean a hasty reduction in the fossil fuel investment, which will keep fossil fuel elevated in terms of prices. And also, given the production of rare earth metals being concentrated in a couple of locations, Congo and China, etc., I think we could have a problem with respect to an IMF. I wrote about it last week in Mint. IMF had a very good 4-pager in its first chapter on the World Economic Outlook as to the value of both industrial metals and rare metals going up in price like crazy, with the total value of production going up to $12 trillion by 2030. That could lead to, in fact, delayed investments, because producing countries may want to cash in on the high prices. And also it could result in hoarding of these metals, etc. So I see, you're right, I do see that as a potential risk factor rather than a potential facilitating factor at the moment for growth. So in that sense, you can argue, Jaggi, that it may come in the way of crossing 7 towards 8. But I still think with the other structural reforms that we are able to undertake, getting to a 6 and 7 range shouldn't be unduly hampered by the climate change being a major disruptive force for growth. It is more of a threat to, it is more of a factor for higher inflation in the decade. But yes, it may come in the way of crossing 7 towards 8, but I don't think it should come in the way of achieving between 6 and 7. That is my response to your question. Are there any other questions or comments or anything from anybody else? Okay. You have from RT, do you have a view on why credit growth in India, generally at a 1.5 time multiplier, still growing below nominal GDP post-COVID? I think the problem is, I don't know whether we have hit the post-COVID mindset. I mean, if you see what is going on with respect to Europe and other countries, I would definitely argue that the post-COVID mindset hasn't really set in some sense. And therefore, the second wave is still relatively recent memory. That is why I would be not that concerned that we have not yet seen it. I don't think the animal spirits are coming in the way they did with the global growth also booming like it did in 2003 when everything came together. Extremely low rates, because rates have been very low in the developed world already for so many years. So it's not a new phenomenon. And financial markets had bottomed out after the collapse. Now financial markets are on a tear already. So in some sense, so there was this massive spurt in growth coming from multiple directions, and those things are not firing on all cylinders. You are seeing capital flowing more into speculative investments into cryptos and stocks, even in the developed world. So I don't think the kind of growth drivers as opposed to financial market drivers that we had in 2002, 2003 are currently present. So when that happens, and when COVID mindset or COVID psychology is truly behind us, and then I have a feeling that 22, 23 financial year onwards, we could actually have a credit growth revival happening. So I still view this as I'm still optimistic about this happening. Even if we don't see it in the numbers right now yet, and that is the best answer I can give to you, Arti, right now. Okay. If there are no further questions or comments, thank you so much for listening, and thank you for signing in and tuning into this. I hope it has been useful for you to form your own thoughts, and advance greetings for 2022 for health, happiness, and prosperity to all of you. Thank you. We'll be in touch. Bye bye. Oh, there's one. Yeah, there's no comment, no questions. Thank you so much. Bye. Have a lovely evening.